Hi, this is David Houle. I'm one of the co-founders of Season Investments, and I'd like to thank you for taking the time to watch this short video on the economics of loss. Although it's one of the most important mathematical facts of investing, the economics of loss is one of the least understood concepts not only amongst investors but also their professional advisors. At Season Investments, our understanding of the economics of loss is foundational to our entire approach to investment management. Shown here is roughly 115 years of performance history for the Dow Jones Industrial Average. Below the line graph, we use the black bars, which are measured on the right-hand scale, to show the depth and duration of all the drawdowns over this period that were 20% or more. These are the large potholes the market hits from time to time that we'd all like to avoid if possible. Next, we use the green bars to show the uptrends that occurred between each of the drawdowns. These represent bull markets in which there were no declines of 20% or more. Now, a few things to point out before we move on. First, the market spent less than a third of its time in the drawdowns depicted by the black bars at the bottom of the chart. In other words, it was in an uptrend more than twice as often as it was in a downtrend. Secondly, the uptrends were much larger in magnitude than the drawdowns. From the late 40s to the early 60s, for instance, the market returned over 700% to buy and hold investors. And finally, over extremely long time horizons, the general direction of the market was up. In fact, $100 invested in the late 1800s would have grown to $1.7 million today before accounting for any fees and expenses. This big picture view explains why so many in our industry would encourage investors to simply ride out the downturns and utilize a buy and hold approach. The problem with this logic, of course, is that most investors have a much shorter time horizon than 100 years, so large drawdowns can have a dramatic effect on shorter-term goals and lifestyle choices. At Season Investments, not only do we believe a buy and hold approach exposes investors to unnecessary risk, we actually believe that an effective downside protection program can result in higher rates of return over full market cycles. To further illustrate this, let's assume that a downside protection program was implemented that allowed an investor to cut the drawdowns in half. This is now depicted by the striped bars overlaid on top of the drawdowns at the bottom of the chart. Now also assume that as a result of having this downside protection program in place, the investor was only able to capture 75% of the gains, as shown now by the striped bars overlaid on top of the uptrends. Under these assumptions, the investor is now outperforming roughly a third of the time when the market is in a drawdown, and lagging for the remaining two-thirds of the time when the market is in an uptrend. At first glance, it may appear that the investor is giving up far more by missing out on the top 25% of the uptrends than they are gaining by cutting off the bottom half of the drawdowns. But as you can see, the result of the hypothetical strategy is actually far superior to the buy and hold portfolio over time. In fact, the ending portfolio value is over 20 times larger than the buy and hold strategy before accounting for fees and expenses, and this would have been achieved with far less risk. Let's look at one more simple illustration that shows the power of the economics of loss. Let's compare two investors' portfolios, both of which generated an 8% average annual return over a 5-year time period. Investor A, in this case, experienced a lot of volatility along the way, while Investor B was able to generate a smooth, steady 8% per year over the 5 years. Keep in mind that despite taking different paths, both investors experienced an average annual return of 8% over these 5 years. Now, does this mean that they ended up with the same amount of money at the end of the day? Absolutely not. In fact, when Investor A's annual returns are compounded over the 5 years, the end result is a realized return of only 0.9% annualized and 4.4% cumulative for the entire period. Meanwhile, Investor B's cumulative results were over 10 times greater at 46.9%. The difference between an investor's average return and their actual compound return is known as volatility drag, and it can be estimated as roughly 1/2 of portfolio variance. In other words, the higher the variance of your returns, the less money you will make over time, all else being equal. In our example, Investor A's return stream had a variance of about 16%, leading to a volatility drag of roughly 8% annualized, while Investor B experienced no variance and therefore no volatility drag between their average and compound return. What's really amazing is that even if Investor B had only compounded an average annual return of 1%, the portfolio still would have outperformed over this 5-year period. This is the economics of loss in action. It is not a fancy theory or hypothetical opinion, it's a mathematical fact. At Seasoned Investments, we believe the best offense is a good defense, and making money over time is more about avoiding deep drawdowns and reducing volatility than it is about squeezing out every ounce of upside during bull markets. Our entire approach to investment management is centered on this core belief. So if you're interested in learning more about our firm and how we might be able to help you grow and protect your assets in today's markets, please don't hesitate to give us a call or contact us through our website. We look forward to speaking with you, and once again, thank you for your time.